Welcome, trader. Today, on this bright day of May 21st, 2025, we embark on a journey. We will explore a fascinating tool. This tool can help you see the market's pulse. It is called the Stochastic Oscillator. Many successful traders use it. They use it to find potential turning points. They also use it to understand market momentum. Think of it as a special pair of glasses. These glasses help you see what many others might miss in the price charts. It helps you understand the speed and energy of price movements. The stochastic oscillator might sound complex, but its core idea is quite simple. It was developed by George C. Lane in the late 1950s. Dr. Lane believed that as prices increase, the closing prices tend to cluster near the high of the recent price range. Conversely, when prices decrease, closing prices tend to gather near the low of the range. The stochastic oscillator measures exactly this. It shows where the latest closing price sits relative to its recent high-low range. This relationship is expressed as a percentage, making it easy to compare. Why does this matter to you, the aspiring trader? It matters because momentum often precedes price. Imagine a ball thrown into the air. Before it starts to fall, it slows down. The stochastic oscillator helps you see this slowing down in the market. It can signal that a trend might be losing its steam. Or it can suggest that a new trend might be starting. Understanding this can give you an edge. It can help you make more informed decisions. It helps you time your entries and exits with more confidence. This oscillator is a popular member of the momentum indicators family. It doesn't predict the future with certainty, no indicator can. However, it provides valuable clues about the market's current state. It tells you if the market is overbought or oversold. These are key concepts we will explore. By learning to use the stochastic oscillator wisely, you add a powerful instrument to your trading arsenal. It can help you navigate the exciting and sometimes challenging world of financial markets. Let us begin to master this tool together. Understanding how the stochastic oscillator is built is key. It helps you trust its signals. It is not black magic, it is simple math. The oscillator consists of two lines. These lines are called %K and %D. The %K line is the main line. It is the one that directly measures the closing price relative to the recent trading range. Think of it as the raw speed reading of the market. It reacts quickly to price changes. This responsiveness is one of its strengths, showing you current conditions. Let's break down the %K calculation. It's easier than it sounds. First, you need a specific period. Traders often use 14 periods, days, hours, or minutes. For this period, find the highest high, also find the lowest low. Then take the most recent closing price. The formula is %K equals 100 times current close minus lowest low divided by highest high minus lowest low. Imagine the lowest low in 14 days was $10. The highest high was $20. The current close is $18. So %K equals 100 times $18 minus $10 divided by $20 minus $10, which equals 100 times $8 divided by $10, which is 80. This means the price closed at 80% of its range. The second line is %D. This line is simply a moving average of the %K line. Most commonly, a 3-period simple moving average is used for %D. This line acts as a smoother. It helps to filter out some of the noise from the faster %K line. Because %D is a moving average of %K, it will lag slightly behind %K. The interaction between these two lines, %K and %D, generates many of the trading signals. It's like having a fast runner, %K, and a slightly slower pacer, %D, to confirm the pace. So, the stochastic oscillator gives you two dynamic lines. These lines move between 0 and 100. The %K line shows the current closing price's position. It's relative to the high-low range over a set period. The %D line smooths out the %K line. This provides more reliable signals. Together, they paint a picture of market momentum. They show if the buying or selling pressure is strong or weakening. Understanding this foundation is the first step to using this tool effectively in your trading. Now that you know how the stochastic oscillator is built, let's learn to read its language. The most common way to interpret it is by looking at overbought and oversold levels. These levels are typically set at 80 and 20. When the oscillator lines %K and %D rise above 80, the market is considered overbought. This suggests that the price has risen sharply. It might be due for a pullback or a consolidation. It doesn't mean you should immediately sell. It's a warning sign. Conversely, when the oscillator lines fall below 20, the market is considered oversold. This implies that the price has fallen significantly. It might be ready for a bounce or a reversal upwards. Again, this is not an automatic buy signal, it is an alert. It tells you that selling pressure might be exhausting itself. These 80 and 20 levels are like caution flags. They tell you that the current trend, up or down, might be stretched too far. Always look for other confirming signals. The stochastic oscillator can also help confirm trends. In a strong uptrend, you might see the oscillator consistently staying in the upper part of its range. It might frequently visit the overbought territory, above 80, and then pull back, but not deeply into oversold territory. This shows sustained buying pressure. In a strong downtrend, the oscillator might repeatedly dip into the oversold zone, below 20. It would then rally modestly before falling again. This indicates persistent selling pressure. Remember, these are just guidelines. Some traders might adjust the 80-20 levels. They might use 70-30, especially in different market conditions or for different assets. The key is to observe how the oscillator behaves for the specific instrument you are trading. It helps to see how it has reacted in the past. The stochastic oscillator is a versatile tool. Its signals about overbought, oversold, and trend strength can be very valuable when combined with good judgment and other analysis techniques. Beyond overbought and oversold levels, the stochastic oscillator offers more subtle signals. Two important ones are divergence and crossovers. Divergence occurs when the price makes a new high or low, but the stochastic oscillator fails to confirm it. This discrepancy can be a powerful warning. It suggests that the momentum behind the current price move is weakening. It might signal an impending reversal. This is a leading signal which can be very useful. There are two types of divergence, bullish and bearish. Bullish divergence happens in a downtrend. The price makes a new lower low, but the stochastic oscillator makes a higher low. This suggests that selling momentum is fading. A potential upward reversal might be on the horizon. Bearish divergence occurs in an uptrend. The price makes a new higher high, but the stochastic oscillator makes a lower high. This indicates that buying momentum is waning. A possible downward reversal could be coming. Crossovers are another key signal generated by the stochastic oscillator. This involves the %K line crossing the %D line. When the faster %K line crosses above the slower %D line, it can be a bullish signal. This is especially significant if it happens in the oversold region, below 20. It suggests that momentum is shifting upwards. Conversely, when the %K line crosses below the %D line, it can be a bearish signal. This is more potent if it occurs in the overbought region, above 80, indicating a potential downward shift in momentum. These signals, divergence and crossovers, add depth to your analysis. They help you anticipate potential changes in market direction. However, like all indicator signals, they are not foolproof. False signals can occur, especially in strongly trending markets or volatile conditions. Therefore, it is wise to use these signals in conjunction with other forms of analysis. Consider price action, support and resistance levels, and perhaps other indicators. This helps confirm the stochastic signals and improve your trading decisions. Section 5. Strategic moves, trading with the stochastic oscillator. Now let's discuss how to use the stochastic oscillator in practical trading strategies. One common approach is the overbought and oversold strategy. When the oscillator moves above 80 or overbought, traders look for potential short-selling opportunities. They wait for the oscillator to turn down from the overbought zone. Often they wait for the %K line to cross below the %D line while above 80. This confirms weakening momentum. A stop loss would be placed above the recent high to manage risk. Conversely, for the oversold condition, which is below 20, traders look for buying opportunities. When the oscillator moves below 20, it signals the asset might be undervalued. Traders wait for the oscillator to turn up from this area. A common entry signal is when the %K line crosses above the %D line while below 20. This suggests buying momentum is picking up. A stop loss would be placed below the recent low. This strategy works well in range-bound markets where prices oscillate between support and resistance. Another powerful strategy involves trading divergences. As we discussed, bullish divergence, where the price makes a lower low and the stochastic makes a higher low, can signal an upcoming uptrend. A trader might enter a long position when the price starts to rise after the divergence. They would look for confirmation from price action, like a break above a minor resistance level. A stop loss could be placed below the new low. Bearish divergence, where the price makes a higher high and the stochastic makes a lower high, suggests a potential downtrend. A trader might consider a short position when the price begins to fall, with a stop loss above the new high. The stochastic cross strategy focuses solely on the %K and %D lines crossing. A buy signal is generated when %K crosses above %D. A sell signal is generated when %K crosses below %D. To make this strategy more robust, traders often combine it with trend analysis. For example, in an established uptrend, they might only take buy signals from bullish crossovers. In a downtrend, they might only act on sell signals from bearish crossovers. This helps to filter out counter-trend signals, which can be less reliable. Remember to always manage your risk with appropriate stop-loss orders. Section 6. Seeing is believing. Example: interpretations of stochastic signals. Let's walk through a couple of hypothetical scenarios. Imagine you are looking at the daily chart of a stock. The stock has been in an uptrend. Recently, the price made a new higher high. You look at your stochastic oscillator set to 1433. You notice that while the price made a new high, the stochastic oscillator made a lower high. This is a classic bearish divergence. It's a yellow flag. It suggests the strong buying momentum might be fading. This doesn't mean you sell immediately. What actions could you take? If you have an open long position, you might consider tightening your stop loss. You might even think about taking some profits off the table. If you are looking to enter a new short position, this bearish divergence is a good initial signal. You would then wait for further confirmation. Perhaps the %K line crosses below the %D line in the overbought zone, or maybe the price breaks below a key short-term support level. This cautious, step-by-step approach helps manage risk effectively and improves decision quality. Now let's consider another scenario. A currency pair has been in a downtrend for several weeks. The price makes a new lower low on the 4-hour chart. You check your stochastic oscillator. You see that the %K and %D lines are well below the 20 level, deep in oversold territory. Then you observe the %K line crossing decisively above the %D line, still below 20. This is a bullish crossover in an oversold area. It suggests that selling pressure might be exhausted, and buyers could be stepping in. What could be your trading plan here? This bullish crossover is a potential buy signal. You might consider entering a long position. To confirm, you could look for price action signals. For example, is there a bullish candlestick pattern forming? Has the price broken above a minor downtrend line? You would place your stop loss below the recent low to protect your capital. These examples show how interpreting stochastic signals in context and with confirmation can lead to more structured trading decisions. Always remember that no signal is perfect, but practice helps. Section 7. The Trader's Toolkit. Advantages of using the stochastic oscillator. The stochastic oscillator is a popular tool for good reasons. It offers several advantages to the diligent trader. One of its main strengths is its ability to identify potential overbought and oversold conditions. This can be very helpful in range-bound markets. It can signal when a price move might be exhausted and due for a reversal or pullback. This gives you a chance to buy low and sell high, or vice versa, within a defined range. This clarity is a significant benefit. Another advantage is that the stochastic oscillator is a leading indicator, particularly when using divergence. Divergence can signal a potential change in trend before it becomes obvious in the price action itself. This can give you an early entry into a new trend or an early exit from a fading one. Catching trends early can lead to more significant profit potential. This predictive quality, though not infallible, is highly valued by many traders who seek an edge in anticipating market moves. The stochastic oscillator is also quite versatile. It can be used across different time frames, from short-term scalping charts like 1-minute or 5-minute to long-term investment charts, daily, weekly, or monthly. It can also be applied to various financial instruments including stocks, forex, commodities, and indices. This adaptability means that once you learn how to use it, you can apply that knowledge across many different trading scenarios and markets. Its principles remain consistent. Finally, its visual nature makes it relatively easy to understand and interpret, especially with the clear 0 to 100 scale and the 80-20 levels. The crossover signals are also visually straightforward. This accessibility makes it a good starting point for traders who are new to technical indicators. While mastering its nuances takes time and practice, the basic signals are not overly complex. This ease of use, combined with its potential effectiveness, contributes to its enduring popularity among traders of all experience levels. Section 8. Knowing the limits. Disadvantages to consider. While the stochastic oscillator is a valuable tool, it is not without its limitations. It's crucial to be aware of its disadvantages to use it effectively and avoid common pitfalls. One significant drawback is its tendency to generate false signals, especially in strongly trending markets. During a powerful uptrend, the oscillator can remain in the overbought territory, above 80, for extended periods. If you interpret this as a sell signal too early, you might miss out on further gains or enter a short position prematurely. Similarly, in a strong downtrend, the stochastic can stay in the oversold zone below 20 for a long time. Interpreting this as an immediate buy signal can lead to losses as the price continues to fall. The oscillator is generally more reliable in ranging or choppy markets where prices move back and forth. In trending markets, it's often better to use it for identifying potential corrections within the larger trend rather than picking major tops or bottoms against the prevailing momentum. This requires careful context assessment. Another point to consider is that the default settings, for example, 14 periods for %K, 3 for %D, might not be optimal for all markets or all time frames. Some traders find they need to experiment with different parameters to suit their specific trading style and the volatility of the instrument they are trading. Finding the right settings can involve some trial and error. This customization can be a hurdle for beginners who prefer a more out-of-the-box solution. Adjusting parameters requires understanding and careful backtesting. Lastly, like all oscillators, the stochastic oscillator measures momentum. While momentum often precedes price, it doesn't dictate price. Economic news, geopolitical events, or sudden shifts in market sentiment can override the signals given by any technical indicator. Therefore, relying solely on the stochastic oscillator for trading decisions is unwise. It should always be used as part of a broader trading plan. This plan should include risk management, price action analysis, and potentially other confirming indicators. Section 9. Stochastic versus RSI, choosing your momentum companion. Traders often ask, stochastic or RSI, which one is better? The truth is, both the stochastic oscillator and the relative strength index, RSI, are excellent momentum indicators. They share similarities, but also have distinct differences. Understanding these can help you choose which one, or perhaps both, might fit your trading style. Both oscillators aim to identify overbought and oversold conditions. Both operate on a scale, typically 0 to 100, with common thresholds for these conditions, for example 80-20 for stochastic, 70-30 for RSI. The main difference lies in their calculation and what they measure. The stochastic oscillator, as we've learned, compares a security's closing price to its price range over a given period. It's based on the premise that closing prices tend to cluster near highs in uptrends and near lows in downtrends. The RSI, on the other hand, measures the speed and change of price movements. It tracks the ratio of average gains to average losses over a specific period. It focuses more on the magnitude of recent price changes. Because of these different calculation methods, they can sometimes give different signals or behave differently in certain market conditions. The stochastic oscillator is often considered more sensitive and can provide more frequent signals. This can be good for active traders. However, this sensitivity also means it might produce more false signals, especially in choppy markets. The RSI is generally smoother and might provide fewer signals, but those signals could be considered more robust by some traders. It tends to perform well in trending markets. Ultimately, one is not inherently better than the other, they simply offer different perspectives on momentum. Some traders prefer the stochastic for its responsiveness and clear crossover signals. Others prefer the RSI for its smoother action and strength in identifying trend momentum. Many traders actually use both indicators together. They look for confirmation when both indicators provide similar signals, or they use them for different purposes within their overall strategy. Experiment with both. See which one resonates with your approach to the markets. Section 10. A touch of tech Python code for the stochastic oscillator. For those of you who are technically inclined or enjoy coding, here's a brief look at how you might calculate the stochastic oscillator using Python. This is a simplified example to illustrate the concept. You'll need a library like for data handling and for plotting if you wish to visualize it. The core logic involves finding the lowest low and highest high, over a specific window, and then applying the %K formula. This demonstrates the indicator's mathematical foundation. First, you would typically have your price data, high, low, close prices, in a pandas data frame. Let's assume you have columns named high, low, and close. You would define your look-back period, often 14. For each point in time, you'd look back over the last 14 periods to find the lowest low, L14, and the highest high, H14. This rolling window calculation is a key step in preparing the data for the oscillator. Next, you apply the %K formula. %K equals 100 times current close minus L14 divided by H14 minus L14. This will give you a new series of %K values. After calculating the %K line, the %D line is typically a simple moving average of %K. For example, a 3-period simple moving average of the %K values. Python's pandas library has built-in functions for rolling calculations and moving averages, which makes this relatively straightforward to implement. This process mirrors the manual calculation we discussed earlier. Here's a conceptual snippet. Python. This code gives you the basic building blocks. You can expand on this to create plots, add overbought or oversold lines, and integrate it into a larger trading analysis script. Understanding the code can deepen your appreciation for how the indicator works. It connects the theory directly to practical calculation.